Hello, everybody. Welcome to the first fall edition of Cup of Joe. I am Joe Gallimore, Director of Investments with Argent Bridge Research. So the equity markets finished the third quarter on a bit of a two-month skid. Rising oil prices and interest rates were the main culprits for this. Now, looking back, this is feeling like a market that got out over its skis a little bit up through the end of July, and has spent the last 2 months backpedaling down to more reasonable expectations. The stock market seems now to be focused on how long interest rates are going to remain higher and when the tightening effects of those high interest rates are going to start to alleviate. And the alleviating of tightening effects are things like mortgage rates declining and what the squeeze on corporate profits is going to be. So until that picture is more clear, we could continue to see market volatility. Now I want to go into a theme that we're going to call, what do market statistics mean to you? Lately, the advisors on the team and I have been discussing a lot of portfolio effects and questions we're getting from clients. So we wanted to throw out some timely perspective with some market statistics and talk about why they should matter to you or why they may matter to you. So the first one I want to offer is that the level today of the S&P 500 was the same as back on May 3rd of 2021, a little over 2 years and 4 months ago. So that means that the trailing return between then and now is flat, excluding dividends, of course. And in fact, the index is still down approximately 11% from its peak in the beginning of January 2022. So it's down 11% in a little under 2 years. But you don't hear that in the media. In the media, we really only hear about the upswings in the market, how the broad index is charging forward, how the NASDAQ is red hot this year, when in reality, those are happening because only a few companies are really contributing to that. We're still not back to where we were pre-pandemic and pre-interest rate hikes on the level of the stock indexes. So when you hear these sound bites on TV, you should think, all right, does this apply to me? And does it? Well, let's talk about index concentration for a moment. Here's a surprising stat. The top 5 names of the S&P 500 account for a whopping 24% of the index. If you expand that list to the top 10 names, those account for 31% of the index. At one point this year, the top 7 stocks in the index were responsible for, I think, around 80% of the index's return. That is pretty much the definition of concentration. So does that previous soundbite apply to you? Well, unless you owned only those 5 or 10 stocks, then you're not going to have that experience. Unless you owned only that one index fund, you're not going to have that experience. And you know that never would we recommend that you focus your portfolio into only the Magnificent 7 stocks or put it even in one single index fund. The second point I'd like to offer, let's talk about interest rates and the Fed for a moment. Here, I want to share that the last time interest rates were this high was July of 2007. I'm going to let that sink in on how far back that is. A person born that year is now a sophomore or a junior in high school. So that was a long time ago. And I say this to imply that this is a market environment that most people are not used to, or at least they've forgotten what it was like. Why is this important? It's because the Fed's actions have an enormous impact on how markets behave and hence on your portfolio. The Fed began raising interest rates last year and volatility became rampant. Before this, a rate hiking cycle of this scale was so long ago that it seems like a lot of people have forgotten what it feels like. Yes, the Fed did raise interest rates for a little bit there in the middle, kind of around 2018, but that was only about half this much. And guess what? During that spell, we saw some volatility. So many economists are referring to today's levels as back to normal interest rates. Now, I take this to mean that savings vehicles are actually yielding you something. And moving forward, the Fed can make adjustments without causing massive price dislocations. And this is what's happened when interest rates sit at such an extreme level, down next to zero, for such a long spell of time. Now, the Fed has said that they intend to keep rates higher for an extended period of time. So investors should reset their expectations and think of this as that proverbial new normal, at least for a while. Now, I want to close this edition of Cup of Joe with bringing it back home and talking about what a recession may mean for your actual portfolios. The first is that the volatility experienced during a recessionary market, that's typically good for actively managed strategies. And we employ several actively managed strategies for our clients. What this volatility offers is what's referred to as price discovery. Now, that's where the market price of a stock is lower than what is implied by the fundamentals of the underlying company. And usually those fundamentals are very good. So active managers love to pounce on these opportunities. When interest rates are super low and everything's just going straight up, there's no price discovery. You can buy anything and it'll win. That's not a correctly functioning market in our view. Second point I'll offer is that typically asset allocation has a much more pronounced effect and impact during and coming out of a recession. An example of this is that small and mid-cap US stocks tend to do very well and often outpace large cap stocks coming off the bottom of economic cycles. Things like growth and specifically tech stocks, those should have less of an outsized effect, the effect we've seen over recent years. And the second part of this is that bonds historically have acted as a stabilizer. So hopefully we'll see more of this as the Fed nears the end of its rate hiking cycle. Bonds have good yields, good interest rates, and they can function without the effect of the Fed changing things. So in the meantime, saving rates are providing a nice return to weather that storm, per se. And the last one I want to leave you with is that recessions offer great opportunities to focus on your own spending. Maintaining an aggressive spending plan, which may be funded by distributions from your investments, that's going to eat up bigger chunks of your assets when the markets are declining. So adjusting your spending is a great way to improve your investing outcome. So I hope these points hit home for many of you. If you'd like to discuss any of these or have any follow-up questions, please reach out to me or your advisor here at Argent Bridge. Thank you very much. Take care.